Listen carefully, because what you are about to hear is something most people never realize in their entire life. Have you ever noticed something strange? Millions of people wake up early, work all day, follow instructions, follow society's rules, and still stay broke. They earn money, they spend money, they try to save a little, they try to budget, but nothing changes. Year after year, their financial life feels like a loop. Different job, different bills, same stress. And here is the uncomfortable truth. Hard work alone has never guaranteed wealth. Peter Lynch, one of the greatest investors of all time, the man who averaged 29% returns for 13 years, a record almost no one has matched, once said, "Most people stay broke because they don't understand how money works. Not because they're lazy, not because they're stupid, not because they don't try. It's because nobody taught them the real rules of money." Think about it. School teaches you how to memorize facts, but not how to build wealth. Society tells you to get a job, but never explains how to make your money grow while you sleep. People are taught how to spend money, but almost never how to invest it. This is why so many adults live paycheck to paycheck, even when they earn good salaries. This is why people in their 40s and 50s suddenly panic about retirement. This is why families fall into debt traps that take decades to escape. Peter Lynch believed that wealth is not about earning more, it's about understanding more. Understanding how money compounds, how small habits become big advantages, how investments multiply, how time becomes your greatest weapon, how your mind affects your financial future more than your salary. He used to say, "You don't have to be brilliant to get rich. You just have to avoid being foolish." But here's the problem. Most people fall into the same 5 or 6 traps over and over, traps that keep them broke for life. Today, we are going to break those traps. Today, you will learn why most people fear investing, why they chase the wrong things, why they quit too early, and how Peter Lynch built a system that ordinary people can use to grow extraordinary wealth. This video isn't about quick money. It's not about luck. And it's not about magic formulas. It's about understanding the simple rules that the rich follow quietly, while the rest of the world stays confused. If you stay till the end, you will see money differently for the rest of your life. The real reason people stay broke. Now listen carefully, because this part is uncomfortable. This is the part most people don't want to admit. Peter Lynch said something remarkable. Everyone has the brain to make money. What they don't have is the discipline. Most people don't stay broke because of a lack of income. They stay broke because of a lack of financial behavior. Let me explain. Imagine 2 people. Person A earns $5,000 a month, but they upgrade their phone every year. They buy things to impress others. They eat out constantly. They buy things they don't need. They never invest because I'll start later. At the end of every month, they have nothing. Zero. Now imagine person B earns only $2,300 a month. Not rich, not special, just average. But they save a fixed amount every month. They invest early. They avoid debt. They ignore lifestyle pressure. They think long-term instead of chasing trends. In 10 years, person B becomes wealthier than person A, every single time. This is why Peter Lynch used to say, it's not about how much you earn, it's about how well you control yourself. Because the truth is painful. Most people sabotage their own financial future, not because they want to, but because of psychology, because the human brain is wired for short-term pleasure. Let me show you the most common traps. Trap number 1, the lifestyle illusion. When income increases, lifestyle increases faster. New job to nicer apartment. Bonus to new phone. Raise to more dining out. Tax refund to unnecessary shopping. And suddenly, more money equals more stress. Peter Lynch called this income inflation. You earn more, but your expenses grow faster. This is why so many high-income people are secretly broke. Trap number 2, fear of investing. Most people say, I don't want to lose money. I don't know enough. I'll start later. So they keep their money in a bank account earning almost nothing. Inflation silently eats it, and 10 years pass with no progress. Lynch said, far more money has been lost by people preparing for corrections than by the corrections themselves. In other words, doing nothing is more dangerous than doing something imperfect. Trap number 3, chasing quick money. Crypto hype, meme stocks, random tips, get-rich-quick schemes, speculation. People want money fast. They don't want to study. They don't want to understand. Peter Lynch warned, if you invest in something you don't understand, you are gambling, not investing. And gamblers always lose. Trap number 4, giving up too early. This is the big one. Most people start investing and then stop after a small loss. They want results in days, but wealth grows in years. Peter Lynch said, you get recessions, stock market declines. If you're not ready for them, you shouldn't be in the market. Most people quit at the exact moment they should hold. They panic when they should stay calm. They stop planting seeds right before the harvest. Trap number 5, no long-term plan. This is the final and most destructive trap. People live financially blind. No system, no plan, no strategy, no goal. So they wander, and wandering leads to mistakes. Peter Lynch had a system. Every rich person has a system. Every successful investor has a system. Today, you are going to learn that system. But before we go deeper, remember one thing. You can fix your income. You can fix your habits. You can fix your financial future. Only if you fix your mindset first.
Peter Lynch's first money rule: know what you own. Listen closely, because this is the rule that made Peter Lynch legendary. Most people lose money for one simple reason. They invest in things they don't understand. They buy a stock because someone on YouTube said it. They invest in crypto because a friend recommended it. They put money in something because it's trending. They follow the crowd but never follow logic. Peter Lynch had a name for this behavior: blind investing. And he warned, know what you own and know why you own it. It sounds simple, but most people never do it. Why this rule matters. Imagine you buy a stock, and suddenly the price drops. If you don't understand the company, you panic, you sell, you lose. But if you do understand the company, if you know what they sell, how they make money, why they're growing, and what their long-term potential is, then a price drop doesn't scare you. It excites you because now you're getting something valuable for cheaper. That's how Peter Lynch turned ordinary companies into 10x, 20x, even 50x winners. He didn't follow hype, he followed understanding. The grocery store test, Lynch's favorite example. Peter Lynch said, if you can't explain the company to a 12-year-old in 30 seconds, don't invest in it. So imagine this. You walk into a grocery store. You see Pepsi, Coca-Cola, Doritos, Kellogg's cereal, Tide detergent, Colgate toothpaste. These are things people buy every day. They're easy to understand. Millions of customers. Stable demand. If a company is simple and predictable, Peter Lynch loved it. But when someone tried to pitch him a complex company like quantum biotech neural ASIC processors for decentralized cloud sequencing, he would say, pass. Because if you don't understand it, you can't judge it. And if you can't judge it, you shouldn't own it. The coffee shop secret. One day, Lynch was sitting in a coffee shop. He noticed everyone drinking Dunkin' Donuts coffee. Long lines, loyal customers, amazing smell. So he thought, this place loves this place. The product is cheap to make. The brand is strong. This could be a great investment. He studied the business, he understood the numbers, he understood the customers, and Dunkin' Donuts became one of his big winners. The lesson? Your everyday life gives you better investment ideas than Wall Street ever will. Look around. the apps you use, the clothes people wear, the stores always packed, the brands people love. Your life is a research tool if you pay attention. The beginner's advantage. Peter Lynch believed beginners have a secret advantage over professionals. Experts overthink, beginners observe reality. He said, the best stock ideas come from the companies you already understand. You don't need an MBA, you don't need Wall Street jargon, you just need clarity. The rule in one sentence: invest only in what you deeply understand, because understanding gives you confidence, and confidence keeps you from making emotional mistakes. Because this rule might completely change how you see investing. Peter Lynch believes something most people find shocking. Every ordinary person has an investing advantage over professionals. Yes, over hedge funds, over analysts, over experts, over Wall Street. Why? Because professionals look at numbers, but you can see real life. And real life always moves before Wall Street does. Let me show you how. Your edge is everywhere around you. Every day you see things that investors sitting in an office never see. You notice which restaurants are always full, which brands teenagers go crazy for, which products sell out, which apps everyone is suddenly using, which clothing brands become trendy, which stores are empty and dying. This is what Peter Lynch called the Main Street advantage. He said, if you stay observant, you will see great companies long before the experts do. Because you live in the real world. The story of the 10x pants. One day, Peter Lynch noticed something simple. A clothing brand became extremely popular among teenagers. Everyone was wearing it. The stores couldn't keep inventory. Kids were begging parents to buy it. He told his analysts, this brand will explode. They laughed. No, Peter, the financials aren't strong enough. Our models don't support it. But Peter followed his edge, simple observation. He invested. The stock went up 10 times. Why? Because customers saw it first. Employees saw it first. Teenagers saw it first. But the professionals saw it last. The rule of local knowledge. You have an advantage because you live in neighborhoods. You see things early. For example, if you notice a small restaurant always full, if you see a new coffee brand becoming popular, if a product becomes a local trend, these small signs often become national trends, and national trends become huge profits. Peter Lynch said, some of the best investment ideas come from your backyard. Not the news, not predictions, not experts, but from observing how people behave in real life. The mom test. Lynch had a funny rule. Whenever his wife or mom liked a brand consistently, he paid attention. Why? Because customers decide winners, not analysts. If your mom suddenly loves a new store, if your sister can't stop using a new beauty product, if your friends are addicted to a new app, these changes mean something. They represent real demand, and real demand builds real money. The beginner's hidden power. Most beginners think, I don't know enough. But Peter Lynch used to say, you already know plenty. You just don't realize it. You know what you buy, what your family buys, what your friends buy, which shops grow, which stores close, which services people love, which ones they avoid. This is data, not numbers, but human data. And this data is often more accurate than expert predictions. Use your edge. Here's the rule in one sentence. Pay attention to the real world, not just the financial world. Real life shows you opportunities long before the stock market does. This is your edge, an edge professionals will never have.
Peter Lynch's third money rule. Know the 6 types of stocks. Listen carefully, because this rule separates ordinary investors from those who build real wealth. Peter Lynch believed every investor should understand not all stocks are created equal. Each type behaves differently, and each requires a different strategy. He classified stocks into 6 categories. Knowing them gives you an edge no analyst can teach you. Number 1. Slow growers. These are the boring blue-chip companies.
They grow slowly, maybe 3 to 5% a year. They pay dividends reliably. Think utilities or giant consumer goods companies. Pros? Steady income. Cons? Won't make you rich quickly. Peter Lynch said, slow growers are safe, but rarely life-changing. Number 2, stalwarts. These companies are bigger, stable, and growing faster, 10 to 12% per year. Examples, Coca-Cola, Johnson & Johnson. They are excellent long-term holdings. Pros, solid growth, moderate risk. Cons, can get expensive if everyone starts buying them. Peter Lynch said, if you pick the right fast grower early, you could see 10x returns in a few years. The key is understand the business and believe in it. Number 4, cyclicals. These companies go up and down with the economy. Think car makers, airlines, and steel. They can be a trap if you buy at the wrong time. But if you buy when the market hates them, you can profit massively. Lynch warned, the stock market is full of fear. Fear creates opportunity for those who understand cycles. Number 5, turnarounds. Companies that are struggling but could recover. These are the comeback kids. They're risky, but if your analysis is right, the reward can be huge. Example, a failing retailer that reinvents itself with a new strategy and grows again. Peter Lynch said, turnarounds are like gold mines hidden in plain sight. Number 6, asset plays. Companies that own something valuable, land, patents, cash, but the market hasn't realized it yet. The stock may be cheap compared to what it's worth. Peter Lynch loved these. He said, sometimes the balance sheet itself is more valuable than the stock price. You just have to notice it. And now, why this rule matters. Many people fail because they treat all stocks the same. They buy whatever is hot. They chase trends. They panic when the market drops. Peter Lynch's secret is knowing the type of stock you own helps you act wisely. It tells you how long to hold it, what growth to expect, how to react to market swings, and when to sell. The practical advice: don't just follow the crowd. Understand what type of stock you're buying. Match the stock type to your personality and risk tolerance. And always remember, the stock is a part of a company, not a lottery ticket. Peter Lynch's 4th money rule: buy what you know. Listen closely. This is one of Peter Lynch's most famous principles, and it's deceptively simple. Invest in what you understand. It sounds obvious, but most people ignore it. They chase tips, follow the latest trends, or buy whatever the news tells them is hot. And that's why so many stay broke. The idea behind Buy What You Know. Peter Lynch believed your daily life is a treasure map for profitable investments. The brands you love, the products you use every day, the services you notice are improving or growing. These insights are your edge over Wall Street analysts. He said, the person on the street often knows more about a company's prospects than the professional analyst because they see it firsthand. Examples from everyday life. Restaurants and cafes. If a small local chain is always packed, consistently popular, and expanding, that could be a fast-growing stock opportunity. Tech gadgets. Notice which gadgets or apps people are using constantly, or which brands get raving reviews. These insights can guide your investments. Consumer products. Laundry detergent, snacks, cleaning products. Simple everyday items can reveal strong companies with growing sales. The key is observation and curiosity. Why most people miss this? Most investors rely on news headlines, follow random stock tips, buy after prices skyrocket, and panic when markets fall. Peter Lynch warned, investing without understanding is like playing roulette. Luck may win once, but it won't last. Buying what you know reduces risk and increases confidence. If you understand the product, the market, and the company, you are prepared for market ups and downs. How to apply this rule? Make a list of companies you interact with daily. Observe trends and growth patterns. Research the company's financials and fundamentals. Decide if it fits one of Lynch's 6 stock types. Invest only when you feel confident you understand the business. And the real secret: Peter Lynch's genius wasn't just spotting trends, it was turning ordinary observations into extraordinary wealth. He often said, "I've made millions simply by noticing what my neighbors and I were buying every day." Your life is full of clues if you pay attention. Your morning coffee, your favorite supermarket brand, the app you use every day, all can reveal untapped investment opportunities.
Peter Lynch's fifth money rule, the power of patience and long-term thinking. Listen closely. This is where most people fail. They think investing is a quick shortcut to wealth. They chase instant gains, panic at small losses, and sell too early. Peter Lynch repeatedly warned, time is your greatest ally in investing, but impatience is your worst enemy. Why patience matters. Imagine planting a tree. If you water it once and check after an hour, you'll see no growth and feel frustrated. But give it time, and the tree will grow tall, strong, and fruitful. Investing works the same way. Compounding, the secret behind all of Lynch's wealth, needs years to work its magic. Even small gains grow into massive wealth if you give them time. The cost of impatience. Most people sell stocks at the first sign of trouble, chase hype stocks, then sell when prices drop. Treat market dips as disasters. The result? They lock in losses, miss gains, and stay broke. Peter Lynch called this the biggest mistake amateur investors make. He said, "You don't have to be a genius, you just have to be patient and understand what you own." Examples of long-term wins. Tech giants. Companies like Apple, Amazon, or Microsoft didn't become massive overnight. Early investors who held on patiently saw exponential growth over decades. Consumer staples. Lynch invested in everyday companies like those making toothpaste, cereal, and household products. Steady growth over years turned modest investments into huge returns. Compounding dividends. Dividends reinvested over decades create a snowball effect. Even a small initial investment can become life-changing wealth if you allow it to grow. How to practice patience. Know what you own. Understand the business and believe in its future. Ignore daily market noise. Headlines are distractions, not guidance. Set long-term goals. Think in years and decades, not days or months. Reinvest and be consistent. Small contributions add up over time. The real secret behind staying wealthy. Peter Lynch's greatest insight wasn't just picking stocks, it was staying invested. He said, "The real money is made by the investor who stays the course, learns from mistakes, and thinks long-term." Most people stay broke not because they can't earn, but because they give up too soon, panic too fast, and ignore the magic of time. Peter Lynch's sixth money rule. Avoid the crowd, think independently. Listen carefully. Most people stay broke because they follow the herd. They buy what everyone else is buying. They invest in the hot stock of the month or listen blindly to financial news, social media tips, or friends' advice. Peter Lynch said, "The person who follows the crowd will usually go broke. The smart investor thinks independently." Why following the crowd fails. The problem with crowd behavior, hype drives prices up, but not value. Fear drives panic selling, even when the company is fundamentally strong. Short-term thinking dominates. You end up chasing trends, not building wealth. Most investors buy high, sell low, and wonder why they never get ahead. Peter Lynch called this the biggest mistake amateur investors make. He said, "You don't have to be a genius, you just have to be patient and understand what you own." Think differently. Peter Lynch built his fortune by looking where others weren't. He discovered small, ordinary companies before Wall Street noticed. He studied everyday products and services that people used daily. He invested in businesses he understood, not because they were popular. The result? He turned overlooked companies into massive winners. Examples of independent thinking. Retail and consumer companies. Lynch spotted chains, restaurants, and brands before they became widely recognized. His research was simple. If people used it and loved it, it might be a great investment. Avoiding market fads. While the crowd chased tech or .com stocks blindly, Lynch focused on fundamentals, earnings, growth potential, and value. Finding hidden gems. Small-cap stocks, local businesses, and companies with steady growth often go unnoticed. That's where the opportunity lies. How to apply this rule today.
Do your own research. Don't rely on social media hype or friends' tips. Focus on fundamentals. Revenue growth, profits, and real-world demand matter more than stock price movements. Invest in what you understand. If you can explain the business in simple terms, you're on the right track. Be contrarian when needed. Sometimes the best time to buy is when everyone else is scared, not excited. The wisdom behind independent thinking. Following the crowd may feel safe, but safety in numbers is an illusion. Peter Lynch reminded investors, Wall Street makes money on activity. You make money by sitting tight and thinking for yourself. Avoid the noise. Avoid the hype. Avoid the herd. Your wealth grows when your mind is independent, patient, and disciplined.
Peter Lynch's final money rule: invest in what you know and keep learning. Listen carefully. The last and perhaps most important rule of Peter Lynch is simple but powerful. Invest in what you know. This means don't blindly follow tips, trends, or market rumors. Instead, invest in businesses, industries, and products that you personally understand and see in your daily life. Why knowing matters? Most people stay broke because they invest blindly. They read headlines or follow the hot stock of the month without understanding the business. Peter Lynch believed that real knowledge comes from everyday observation. The stores you visit, the products you buy and love, the services you use and recommend. If you notice a company growing steadily, serving people well, and solving real problems, that's your opportunity. The power of lifelong learning. But knowing what you use isn't enough. Lynch emphasized continuous learning. Read annual reports, understand revenues, profits, and risks, track trends, technology, consumer behavior, and emerging industries. Learn from mistakes. Every loss is a lesson if you analyze it. Stay humble. The market changes, and knowledge is never complete. By combining personal experience with research and learning, you create a unique advantage over the average investor who relies on hearsay. How to apply this rule today? Observe your world. Notice which companies are growing and why. Invest in familiar businesses. If you understand how a company makes money and why people use its products, you're ahead. Commit to research. Read, watch, and analyze continuously. Knowledge compounds like money. Be patient and disciplined. Stick to what you know even when trends distract the crowd. The real secret behind Lynch's success: Peter Lynch didn't rely on luck. He didn't try to time the market or predict the next bubble. He relied on observation, seeing what works in the real world. Research, understanding the business and its potential. Patience, holding winners long enough for them to grow. Learning, continually improving knowledge to spot opportunities before others. This combination allowed him to transform ordinary companies into extraordinary wealth. Conclusion: escape the financial trap. Most people stay broke because they never understand how money works, follow the crowd, or ignore the power of knowledge. Peter Lynch's rules offer a clear roadmap. Understand money and how it grows. Spend wisely and avoid debt traps. Invest for the long term. Find undervalued opportunities. Be independent. Avoid the herd. Invest in what you know and keep learning. If you apply these principles consistently and patiently, you can escape the financial trap that keeps millions struggling. Remember, financial freedom isn't about luck. It's about knowledge, observation, discipline, and action.